Joining us now is Dan Niles, founder and portfolio manager of Niles Investment Management, and a longtime skeptic of some of these Mag 7 valuations. So a little pat on the back, perhaps, for you here. But, Dan, you say you expect the rest of the S&P 500 to do better than the Mag 7 mega caps. Doing better could mean going down less. How confident are you that we end the year higher than here?
So I'm a big believer of investing when you have tailwinds behind you. And you have to remember, we've got multiple tailwinds. The first, obviously, is the Fed went 50 basis points. And there's a reason there's this saying, don't fight the Fed. And rates are probably going to continue to go down. Inflation's down at 2.5%. The Fed will probably be aggressive over the next 12 months of continuing to lower rates. That also gave air cover to the world's second largest economy, China, to go ahead and finally pull out some big stimulus. And we've seen it in how much the China equity markets have rallied. And so that's also supportive for U.S. companies that sell into China. And all of this has given other central banks the ability to go ahead and be a little bit looser with their policy. And so you just don't want to fight that kind of tailwind going forward. Now, to your point, though, as we go into earnings, it's going to come down to individual company earnings. And there, I think you're going to see a big bifurcation between the guys that are continuing to do well and the ones that missed. Well, are they going to improve in terms of what their outlooks are going forward? And I think that's where the risk is, which is why we like a broader basket of S&P 500 stocks. Much like you saw in Q3, the equal weighted basket of the S&P was up 9.1%. The S&P itself was up 5.5%. And the information technology sector was up 1.4%. So it lagged pretty badly. And I think we're going to see that continue through year end.
What do you do here? You mentioned China. What do you do here with Chinese stocks, even China ETFs? Has the move already happened? Are there other effects of that stimulus, like you mentioned, those selling into China, that are more interesting to have play out from here?
It's a great question, John. I think I always look at valuations as a necessary but not a sufficient condition. And what I mean by that is China's been cheap, but it's been cheap for years. Even with this move higher, the multiple's only 15 times. You compare that with the S&P sitting at 24 times, or the Indian stock market, which is at about the same level, which has been one of the best performing emerging markets for a bit, and you go, wow, there's a lot of room for that to continue to improve. And I think the Chinese government, after a very long period saying, nope, that's welfareism if we give out checks to consumers, they bit the bullet and said, well, unemployment's a bigger risk, and so they started handing out checks. And so I think you've got still a lot of room for that to be valued. But don't forget, we have the U.S. elections coming up. The Republican Party has floated 100% tariffs on China. That's obviously a negotiation point to start with. But, you know, if we end up with much higher Republican control of the government, you know, the day after the election, China's probably going to get hit. So for right now, we've got very big cash positions. We've got a big position, the equal weighted S&P, and we want to get through that because depending on who takes power, that can be very positive or negative for China, at least in the short term, and it gives you an opportunity to then deploy into what makes sense.